Okay, well, hello everybody. This is going to be part two of the class session that was to have taken place on Thursday, September 11th, and we had some issues with the apparently with the Zoom Enterprise Edition that we're working with. Our IT people tell us that there were some changes made to it that we were not advised of, and I'm not sure what the technical details are, but that's why we had to bring someone over. And unfortunately, it wasn't a matter of him running downstairs or whatever. He had to come from a different building across campus and do a little bit of work. So we lost lots of time. I apologize. It's a strange situation. I think we lost like 45 minutes of the class session on Thursday. So I'm going to record this now to sort of supplement that. My goal is to, by Tuesday then, to cover the remaining content from chapter two. And again, I've defer the due dates for the quiz and homework for chapter two to next week. So hopefully that should be agreeable to everybody, and hopefully this video works. Hopefully we're doing this. So a couple of things I just want to kind of bring everyone up to date as to just some details here that have come about. And first of all, one of these has to do with the issues with YouTube. Some of the, if you had saved the URL, I don't know that that works anymore because apparently whatever happened, it kind of cleared those out. So if you're watching this on a live stream, which you're more than welcome to do, 10:30, 11:45, Tuesday, Thursday, just make sure you get into the Brightspace landing page, the main page, and make sure you've got the right link. Most of you, I'm sure, know to do that, but if you saved it and think this is going to be the one for the entire term, it's probably not. So just kind of make sure you do that. Also, the videos that I'm recording for this, because this is an attend anywhere section, are also being used by a purely online section. So some of you who are watching this at some point down the road are in Natalie's section, and some of the things that may apply to this particular section may not apply to hers, and so things like due dates and whatnot. So just make sure that you are, if I talk about due dates and whatnot, things that are very specific to this attend anywhere section A01, A02, that may not apply to yours. So just kind of make sure, and if you have questions about any course content or due dates or course policies or whatever, please get with Natalie, okay? Also, due dates, I mentioned at the outset of the class on Thursday that I was deferring, and I just mentioned a second ago, deferring chapter two's content or activities until this next week. That way it gives you a little bit of time to work on that. And my strong preference over a very long time period is to try to give people more time to work on things as opposed to less. This will sort of create a bit of an issue for you when it comes to the week 5, where we have our first exam. Chapter 4's activities as well as the first exam will come due. And so, as I mentioned before, just kind of pace yourself and make sure that you are not waiting till the last minute to do all of these. Yeah, it's my experience. That's usually not a very good outcome. All right. So, okay. So let's go ahead. And by the way, whatever we don't get done on Tuesday in class, I'll probably just record a supplemental video to that as well. There's a lot to do in this course. I mean, intermediate accounting, it's a dense course. There's no doubt about it. It is interesting though, for those of you who aspire to be professional accountants. This is the course that this and intermediate 2 are the courses you've got to get through. And but it's an enjoyable experience if you like accounting. If you don't like accounting, well, it's maybe a different story. But this is sort of the gate, as I mentioned the very first day. It's sort of the gateway to the profession. So sort of think about it that way. Okay. All right. I'm going to pick up from where we left off with our very abbreviated live session on Thursday and talk about the 11th. Talk about some transactions that are going to be recorded in journals. Remember, journal entries are in the debit credit format, debit all to the left, credit slightly addendum to the right. And so we've got a number of different events or transactions. And I use the word events because not every thing that's recorded is a transaction. Particularly it's what we call internal events, things like, accruing interest on things that we own, or depreciating assets. That's probably the best example, or accruing wages and whatnot. But not all events are transactions, but all transactions are events. but they're all recorded in a very similar format as to debit and credit. So here's an example. So just to kind of take some of these examples that we're given here. On July 16th, the company that we're talking about here subleased a portion of the building to a jewelry store, received $1,000 in advance for the first 2 months of rent beginning on July 16th. Okay, so what you've got is this is a classic case of a deferral, and a deferral is any kind of condition in which the money precedes the activity itself. Now remember, in accrual accounting, don't follow the money, follow the activity. And we're going to post this as an asset in terms of cash received, but it's also we also haven't delivered anything, and so it's deferred revenue. We haven't earned it yet, so we're going to sort of book that here as a credit. So it's a liability. Remember, liabilities are credit balance accounts. So as a result, that's how we journalize that particular transaction on July 16th. We're assuming this is going to be a half a month, and we're going to go with the way rent usually works, the first of the month to the end of the month. Second transaction, record payment on account in a journal, paid Birdwell Wholesale Clothing $25,000 on account. Well, if there's a payable, which is a liability, it's going to be reversed by a debit because it's going to have a credit balance account. So we're going to credit cash, and we're going to debit accounts payable, and that's how that transaction occurs. Nothing too complicated. This is really just transaction posting, and after journalizing, we're going to post these entries to the GL, general ledger, so that we can update the balance in all the specific accounts, whether they're very broad accounts like things like cash, or whether they're very minute accounts like individual client accounts, that sort of thing. Okay. On July 20th, we paid salaries to employees for the first half of the month and $5,000. So we're going to recognize an expense. This is an income statement item, but it's going to be if it's an expense, a charge, it's going to be a debit balance, and we're going to credit cash for $5,000. Okay, and pretty straightforward types of transactions as far as that goes. July 25th, we received $1,500 on account from Briarfield. So we're making the assumption here that it's receivable, that we've sold something, a good or a service, to Briarfield, which is a customer. And they probably will have their own unique customer identifying number. And so cash is debited, which is an increase in cash, and we're going to credit the account receivable. These are both asset accounts, and so we're going to reduce the account receivable. And by reducing an asset, we enter a credit. And so as a result, we have credited that particular customer's account. Okay, and we have a number of these, and they're just good ways to kind of walk through these events that happen that need to be recorded on a routine basis. And the next one is July 30th. The corporation paid its shareholders a cash dividend of $1,000. Now, this is a little bit different, and we're going to talk a little bit more about dividends later. And I think it also comes up again in 2130, which is the intermediate two. But dividends are really a reduction in shareholders' equity. And I talked a bit about this prior. This idea that shareholders' equity, because it's a right side balance sheet type of activity, it's going to have a credit balance typically, but we're going to reduce it. So a dividend is simply a distribution back to owners of their ownership interest. Yes, it does tend to track income, but not always. And so I think we're on shaky ground to say that dividends always are correlated with income, because that's not always the case. And companies pay special dividends at times, sometimes pay stock dividends. But in this case, this is a cash dividend. So cash is going to be reduced by $1,000, and we're going to decrease shareholders' equity, which is a special account called dividends. And all dividends are simply a distribution back to owners. And yes, it does represent some sort of reward or return to shareholders. I'd be naive if I stressed that was not the case. Many people buy stock as investors in order to receive dividends, and dividends and the receipt of dividends and company dividend policies are really sort of beyond what we're doing in this course. It really sort of belongs more to finance, but nonetheless, we're only really talking here about the accounting treatment. Okay. All right, a quick quiz question here, concept check. Recording expense. So recording expense for salaries incurred and paid in cash would be recorded by which? All right. Debiting a liability, debiting expense, debiting cash, or creating an expense, and the answer to this is going to be debiting an expense. That's really what salaries earned and paid would be. Okay. Now this assumes, of course, that that we have an accrued liability here, an accrued expense, which creates a liability, and so we're gonna debit an expense. Actually, no, we're not accruing a liability. We're simply creating an expense. And in this case, debiting a liability. Actually, it can go either way, but I think what they're really going for is we're recognizing the expense very, very quickly. Salaries and wages are paid obviously very quickly. Workers can't work and get paid a year from now and whatnot. But sometimes you cross an accounting period and you have a liability of accrued wages or salaries or whatever. In this case, we're just simply saying, okay, they work 2 weeks and they're going to be we're going to pay them, and so we're going to debit an expense. And we're going to credit cash, right? Workers are paid in cash, right? So as a result, debit expense, which is salaries, wages, whatever it is, and credit cash, okay? Also recording common stock, the journal entry to record the issuance of stock in exchange for cash involves what? Well, remember, so stock is a shareholder's equity account, and it typically has credit balance, right? And so if we're going to issue common stock, what are we going to do? Well, it's going to be that we're going to receive cash, which is going to be debit cash. And by debiting cash, we're simply raising the cash balance. We've sold stock to outside investors or inside investors, whomever, doesn't matter, but it's an asset, so that goes up. And then we're also going to raise common stock. So the left side of the equation, the accounting equation, is going to be cash. That's going to go up, and stockholders' equity is going to go up as well. So as a result, we have a debit credit balance, but also the tabular summary, that is the accounting equation, also balances in this regard. So that all makes sense. Okay. All right. Now, when it comes to the posting of these, let's take a look at what's going on here. So in this case, we've got some examples, and again, all these come out of your text. And if you want some further context as to some of these, because I have to kind of move a bit quickly here because I don't really have time to delve into some of these. Not that I don't want to, but it's just we sort of need to move quickly. But in this example, what do we have? We're posting what? We have prepaid rent and we have cash. And so, and again, a lot of times with journal entries, you have some sort of reference that brings you back. If you want to know, hey, what was this? You can look back and pull up whatever the kind of reference is. A lot of times there's some sort of text that describes what's going on. In this case, we're going to prepaid rent. Now, prepaid rent is a deferral, right? It's something that, remember, the rent comes, the payment comes first, the activity comes later. And so in this case, we are the party paying the rent, so it's an asset to us. Right? And why is it an asset? Because it's a resource that we own and control, and has future surplus value to us. And so over the period of time that this rent is expensed, we enjoy the value of that. And we reduce cash as a result. So both sides of this transaction balance. And what does it look like on the GL standpoint? Well, basically, we're crediting the cash account. And we have all these other transactions. We don't know what they are. It doesn't really matter because we're only focused on this one. But keep in mind, we have a running balance here, right? That's basically this minus this. Hopefully, if it's cash, we have a debit balance. Otherwise, we have an overdraft. That's not great. But that's what's going on there. And so all these are entries that are posted to these general ledger accounts, and that's the way that we sort of keep track of the balances in those. And as of July 31st, the only thing in prepaid rent was that particular transaction. Okay, and as the rent is incurred or experienced, whatever you want to call it, we simply call it incurring the rent, and we're going to expense that rent, and we're going to create a rent expense, and we're going to bring down that prepaid rent, which is an asset, because we are going to use that up, right? And that's what it really means to use up an asset, is to experience that. Okay. And in terms of general ledger accounts, we've got just a collection here. This is maybe a little hard to see. I can blow it up if I can blow it up. But you got different, and I don't. Maybe you can see this, maybe not. But different cash accounts. You get cash, prepaid rent, accounts receivable, inventory, and whatnot. And these are sort of the GL accounts. So these are arranged in sort of a T account format, and the T account is really just a way of sort of visualizing these these accounts as we get going. Okay. The big thing is to take the journalized entries and putting them into the general ledger accounts themselves. And so Here we've got a number of different transactions that are going on. And so what you're simply doing is you're posting to the general ledger all these events that are happening. Ultimately, the goal clearly is to get to the point at which we're preparing financial statements. Those accounts which relate primarily to the income statement, activities, revenue, expense, gains and losses, etc., are going to be closed. And once the accounting period in question is closed, and then simply reopened, and we'll go from there. But there are accounts, typically balance sheet accounts don't get closed because they represent assets and liabilities that don't go away. So, and it's a different kind of view. And remember, one of the metaphors that we used in introductory accounting was the balance sheet is a snapshot at a point in time, December 31st or whatever, and we're freezing all the activity, all the assets, liabilities, shareholders' equity, taking a picture of them, and then they will change over time as we move into a new accounting period. But the income statement, again, those two statements are the most important ones by far, is a motion picture. So snapshot versus motion picture. Things are going to change a lot when it comes to the income statement, and companies are earning revenue and incurring expense. A lot of companies on a 24/7 basis, and so those things are changing over time. Okay. All right. Let's talk about trial balances and what these are all about. And I think it's important that we sort of get into this a little bit and talk about what's happening here. So what is a trial balance? A trial balance is simply a means. I'm trying to bring this down a little bit here. A trial balance is simply a way that accountants can be assured that the accounting balances are in fact in balance. And maybe that's a very inarticulate way of saying it, but it's basically a way of making sure that debits equal credits at the end of an accounting period. This task is made a lot easier with software. Back in the day, I can imagine this is probably a grueling process of trying to figure out why debits don't equal credits. But for the most part, as we're entering transactions within accounting software, whatever the software is, whether it's some of the more basic ones like Sage or even QuickBooks or NetSuite, you're probably going to be flagged if something doesn't balance. But nonetheless, you still want to do this, make sure that everything balances. The debits have to equal the credits, and that's just the way it has to be. Remember, theoretically, well, not even theoretically, practically, as a practical matter, all debits must equal credits, and that's just the way it sort of has to be. So here's an unadjusted trial balance. So you get a list of accounts. Now, these are pretty much all the accounts that we're talking about here. So think about this. This is a company called Dress Right Clothing. And you've got balance sheet accounts, you've got income statement accounts, you've got cash, receivables, and all that, and they're all good. And you have to at the end of time, you've got to do a trial balance. The debits have to equal the credits, and if they don't balance, you've got to find out what is going on there. And we call this an unadjusted trial balance because why? Because we have to do what's known as adjusting entries. And I think I mentioned earlier that I sort of view adjusting entries as being routine maintenance. And these are things you've got to do, particularly and probably most notably as you are at the end of an accounting period, whether it's a quarter or a year. Definitely at the end of some year, you're going to want to do adjusting entries. You're going to want to bring things current because they're not really going to be affected by day-to-day activities. Depreciation comes to mind. It's a huge one, right? And I know software does it, and I've certainly worked with my share of software where depreciation is immediately updated, but we need to make sure that it is updated and everything is correct. But even beyond that, things like accrued interest, where maybe your accounting software doesn't do it. You have accrued interest on things like bonds, where it's held by a broker. You want to update the interest that's been accrued. You haven't received it yet, but you've accrued it, and so you want to bring that current. And that's that's one example of an adjusting entry. And that would be an accrual. That is something where the activity comes first, the payment comes later, and as a result, you want to bring that current. One huge one is certainly salaries and wages, and it's a real huge priority for every firm to make sure that employees are paid on time and in full, and so you want to make sure that you are recording those, bringing those current. particularly as you cross an accounting period, we've got an accrual of wages and salaries. And everything that really goes along with payroll, and for those of you who took Business 1180, everything that goes along with payroll includes things like payroll tax that the employer is obligated to pay on behalf of the employee, that's Social Security and Medicare, but also some of the other related taxes like unemployment benefits and employee benefits and workers' comp and all those kinds of things. All these things have to be brought current, and that's what an adjustment really is. And it's simply sort of a routine maintenance. And so here are the issues that we're really highlighting in the adjusting entries category. And we're talking about primarily internal events. That's really what we're getting at. I mean, these are like if we accrued salaries and wages, that's an internal event. It doesn't involve a counterparty. The employees work here at this company, and so as a result, we're going to accrue wages and whatnot. And the accrual accounting model is the template that we're looking at here in intermediate accounting. And I know that a lot of businesses don't use accrual accounting, particularly smaller businesses, because the cash basis method is way easier to implement. But from a GAAP accounting framework, accrual accounting is what we have to use. And so we're going to accrue expense and we're going to accrue income as things are earned or incurred, not when they are paid. That way we can match up activity against activity, and wherever the money falls is wherever it falls. That's really the heart of what accrual accounting is all about. So adjusting entries are really adjusting for these two categories. Prepayments are what we sometimes call deferrals. And what's being deferred is the activity, not the payment, right? Payment comes ahead of time. And they take two different elements here. And one is an asset, one's a liability. Prepaid expenses are assets. We're paying, and the example we just talked about was prepaid rent. We're paying $24,000 in rent. And I don't know what the term of it was, but it doesn't matter. We're capitalizing it as an asset. And you might think, well, how's an expense an asset? Well, because we've paid it ahead of time. And we have the benefit of that. We've paid it ahead of time. And that's not the only one. Prepaid rent is by far not the only one. Insurance comes to mind as being really a classic example of a product that is absolutely necessary. And for the most part, it's paid ahead of time, just by the nature of what insurance is. And that becomes an asset. And as it's used up, then we expense it. But at the initiation, we're gonna deal with that. But we are going to adjust it. So over time, so if we paid 6 months of prepaid insurance and we have an accounting period that has 2 months of incurrence, we're going to record those 2 months as an expense, but the other 4 months remains as a prepaid item or a deferral. Deferred revenue. So this is an asset. This is a liability. Deferred revenues. We're paid ahead of time for something we haven't yet delivered. So we have a liability. Remember, a liability is a claim against the firm, right? I think the sort of wonky formal definition is it's a claim against assets. Well, yeah, it is, but it's also a claim against the performance that is required of the firm. So we paid ahead of time for a cruise to Disney Cruises or whatever, right? Well, Disney would record a deferred revenue for all the money that they've received up front, and they've got to deliver it. It's a liability. They don't create a revenue as an actual sales revenue on the income statement until they've actually delivered it. So, and there are a lot of these kinds of cases in which sellers of goods and services receive payment up front, and they have a liability, which means they have a responsibility. Okay, so those are the prepays or deferrals. Accruals or accrued liabilities, those things, these accrued salaries, accrued wages, accrued whatever, come up, and also accrued receivables. And remember here, it's just the opposite event where the money comes here. The money comes before the activity. Here, the activity comes before the money. And so all these have to be adjusted. Okay. And once these accounts that are related to it are adjusted, then we can do what we call an adjusted trial balance. And that's what's really going on there. And all we're really talking about here is prepayments, sometimes called deferrals, and that may be an old school term, but prepayments or deferrals, prepaid expenses, deferred revenues. And some examples here look like this, where the adjusting entry, now by the way, this is not the original entry. This is the adjusting entry. So if we're talking about insurance, for instance, right, where we paid, I don't know, for a year of insurance up front, and our accounting period has ended, and we've incurred, and we've used up 3 months of that insurance, and we're going to credit that asset being prepaid insurance, right? And we're going to create a debit for an expense. Remember, expenses are debit balances accounts, okay? And so what is the effect on the financial statement? Well, obviously it's going to bring income down because expenses by definition bring income down, and we're also going to bring assets down. So, and again, expenses also decrease the value of the firm, which is why the balance sheet effect is also notable here. Okay, so that's the treatment of prepaid expenses. So one example, and I think I've made clear my ambivalence about this example of prepaid supplies, but nonetheless, let's just kind of go with it here. We have an example is the Dress Right clothing company purchased $2,000 of supplies in July. Assume that Dress Right determines that at the end of July, 1,200 of supplies remain. Well, what are we saying here? That they've used up $800 of supplies, which means that supplies, which are an asset, was booked originally at $2,000, so it's a debit to supplies, and we've used up 800 because 2,000 minus 1,200 is 800. So we're going to credit supplies, bring that down, and then recognize supplies expense. Okay. So again, the debit and the credit equal each other, and that will be an example of an adjusting entry. Someone's got to determine how much in supplies remain, and once we've determined that, the difference between the original value, which we tend to record assets at cost primarily, not always, but and the difference between those is going to be an expense that represents the decline in the value of that asset. Okay. The prepaid rent example, this is the one I got to a second ago. We pay $24,000 ahead of time for 1 year's rent in advance, so it's basically $2,000 a month. So at the end of July, we're going to reduce the prepaid rent asset by $2,000, and we're going to record rent expense to balance that transaction out. That's an adjusting entry. That's sort of routine maintenance that goes on a fairly routine basis, and that's just sort of bringing things current. Okay, it's just like changing your oil or washing your dishes or whatever kind of ridiculous metaphor you want to go with. But that's what's really going on there, is this idea of we're bringing things current, because as the current case is, things are not going to be current unless you do that. Okay. And then we get into long-lived assets and depreciation. Depreciation is an interesting topic. Not all long-term assets are depreciable. Land is one of those that comes to mind as being a non-depreciable asset, but most long-lived assets that we call long-term assets are depreciated, and they're depreciated usually for the estimated useful life, whatever that is, and however that's determined. And there are some different depreciation methods, and we'll get into some of that a bit later. But for the most part, in this example, this is, I think, relatively straightforward. We had office equipment was purchased during July for $12,000. So we're going to, and that's not shown here, the $12,000 debit to equipment, but we're going to assume it's a 5-year useful life, and it's going to be worthless at the end of that period. So I think that we can assume what's going on just in this context here is that we've got a what we refer to as straight line depreciation. And when we talk about how straight line depreciation works, straight line is simply saying we're going to take even amounts of depreciation. So straight line depreciation expense is going to be based upon this cost minus the residual or salvage, or I mean, there are different terms for this, divided by the estimated useful life. Okay. And that's what straight line depreciation is. We call it straight line because we take an even amount every year. There are different methods, and I think if you took 21 cent or the equivalent somewhere else, you probably were exposed to declining balance or units of production method. There are different means by which we do this, but in this case, let's just kind of do the math here. So what do we have? The cost of this asset was $12,000, and we're saying there is no salvage, and it's going to, what is it, a 5-year? So it's going to be 60 months. Okay. And so 12,000 divided by 60 months. I think it's just one year that we're doing it, is going to be $200. Okay. $200. Now, typically we put things in I would probably have put this as 5. So 12,000 divided by 5 is going to be a certain dollar amount. Here we're just doing for the month, so you got to make sure your time frames are correct. So we have $200 of depreciation, and depreciation is simply an adjusting entry that we are reducing the value of that particular long-term asset. And what depreciation is an allocation method. It doesn't at all necessarily reflect the reduction in value that would mirror the fair market value. It just doesn't, and that's one of the areas that is a little bit dicey when it comes to depreciation. But we have to depreciate long-term assets because we recognize there's a loss of economic value. They're going to wear out. They are wearing out. They're becoming obsolete, whatever the case might be. Now, the credit here is accumulated depreciation, which is a contra asset. And a contra asset is simply, or any kind of contra account is any kind of account that attaches itself to some particular reference account. And what I mean by that is the idea that we have lots of contra accounts everywhere in accounting. Contra assets, contra liabilities, contra revenues, contra expenses. And they're simply used as a means of communicating information to users about what has gone on over time, and it's just really a means of communicating something related to those particular reference accounts, and that's really what this is about. I can't the most obvious contra account everywhere in accounting, I think, is probably accumulated depreciation. I think it's in most cases, I do believe it's the first one we talk about in accounting coursework, and that's really what's happening there. Okay. And I don't know if you can see this or not. Let me sort of swivel the. It's been a strange semester. They changed a lot of our equipment around and whatnot. So hopefully you all can see what's going on there. That's the straight line method. That's not really the main thrust of this particular learning objective, but it does kind of show you what's going on. Cost minus salvage. Salvage is sometimes called residual value. It's what something might be worth at the end of the expected useful life or estimated useful life, and we really don't know. I mean, it's guesswork, and but it's got to be an educated guess. You can't have something unrealistic, and accountants are charged with making realistic estimates. And we certainly, in my particular field, I'm primarily a tax person. We are really charged with trying to make realistic estimates at all times. Okay. All right. So that's the example that comes from that particular adjustment dealing with depreciation. And the concept check here is the correct amount of prepaid insurance should be $1,400 as of December 31st. The company paid an additional premium of $1,100 in May. That was the following year. And by December 31st of the next year, 2022, in the balance sheet, the amount of prepaid insurance was correctly shown as $1,000. Then what is the amount of insurance expense that should be reflected there? Okay. So this is an example of something that I think is important for us to realize. And it's something that I think as accounting instructors, we try to do our best to try to encourage people to sort of use the T-account method. So I'm going to kind of zoom out here a little bit, and I'm going to kind of go over here just a bit if I can, and talk about what's going on here. So, and my thing is not working. I guess I've zoomed out all I can. So, all right. So let's take a look here, and maybe I'll bring the lights up a bit and talk about what's going on. So, all right. So let's look at the problem at hand here, because what we're being asked to do is determine the amount of insurance expense, right? So why don't we do that? So I'm going to set up a couple of T accounts, and the first is going to be prepaid insurance, which is going to be an asset, right? So prepaid insurance is going to go there, and we're also going to have insurance expense, which is going to be an income statement account, okay? And so let's kind of go through this. So at 12/31 of 21, what are we told here, right? We're told that the balance in this asset account is $1,400, okay? And we're also told that as of 5/1, we've purchased more insurance, right? 5/1 of 2022, right? So we're to the next year. Apparently, we've closed the books on 2021. We're moving into 2022. So 5/1, of 2022, we bought $1,000 of more insurance. Okay. So, and those are all the insurance transactions for this enterprise as of December 31st, 2022. So let's do a little bit of, we'll sort of do a little subtotal here. Now we have $2,400, I'm sorry, $2,500 in this particular account. And then what we're trying to do here is we're trying to figure out this thing here, what goes here as the insurance expense, the debit balance. And so all we really know is that as of 12/31 of 2022, the balance is $1,000. And so how do we get from 2,500 to 1,000? Well, we must have incurred somewhere along the line $1,500. And the dates are indeterminate. It's over time, so there's no individual date, but it's going to have to be $1,500 in order to get us to this ending balance in this account, ending balance. And again, I think we're assuming the year end is 12/31. That's not every company again has a December 31st year end, but we're going to make that assumption here. So we have $1,500 here. That's a credit, and the balance, which is going to be over a period of time, is going to be $1,500. And so $1,500 is going to be the expense, and that's the amount that was incurred in that particular accounting period. All we're doing is sort of working backwards here in order to try to determine how much insurance expense there was. Okay. And we like to encourage the use of T accounts because I think it's a good teaching mechanism. It's a good way to sort of visualize accounting events. And this is something that I think I mentioned to the class before, that I've seen lots of accountants use T accounts over and over and over again, just to, particularly when something is a little bit dicey and tricky and we got to kind of think about this. What are we doing here? And they'll present T accounts to kind of work things out. And it's a logical tool, even though these are not the actual accounts that we're posting to, but we're sort of working these out as more or less a what if. All right. Okay, so am I right? Is the answer 1,500? No, the answer is 15. That's good. I get to keep my job, so it's $1,500. And that is the idea that we have incurred at a beginning balance. We incurred an additional amount of payment, and I think I might have wrote this down. I think it was 1,100, wasn't it? I think I made a mistake here, so maybe I don't get to keep my job. So it's 1,100, not 1,000. So my bad. So it does up to 2,500. I just wrote it down wrong. My notes were correct, but that is what's happening there. Okay. And if you have questions about anything that I'm talking about here, just get with me. I'm here every day for the most part, so I'm more than glad to kind of walk through all of these concepts. Okay. When we talk about alternative approach, this is just another way of getting to the same place, and you can do it if you like. In this case, we have the same prepaid rent scenario where we paid $24,000 up front, and I'm going to kind of hopefully this is more easily visual for everyone. And let me know if when you're looking at this on your own, if you want more light in the room or less light. It's kind of hard for me to know how it looks from your point of view. So just let me know what you kind of prefer here. So the company could have debited rent expense and the adjusting entry records as of the end of July. So they could just simply book everything to rent expense and then just make the adjustment to rent expense. I'm not a fan of this particular approach, but you could do it. We're going to get to the very same place. There's not going to be any change at all. I just think it's a little bit extra step. Now, why would you do this? Why would anyone do that? Well, I think one explanation is that sometimes these entries into accounts are made by bookkeepers who may not be totally versed on the intricacies of accrual accounting. I think that's probably the best explanation. So they may book it directly to rent expense, and so just simply debit rent expense for everything and whatnot. But somebody's got to come along and make the adjustment because you clearly are not going to incur $24,000 of rent on a $2,000 per month basis. We're just talking about 1 month here, so somebody's got to make an adjustment at some point. But I think that's probably what's happening in this example. Is somebody who's doing the initial entry and really doesn't know how to set up for deferrals in this case, and so and that could be one explanation as to what might be happening there. Again, I think it's a long way to get you there. And by the way, you're still going to have to do some sort of adjustment, but that's one theory as to what you might be saying. Okay. All right, deferred revenues. This is again a liability, right? We've gotten revenues from somebody for something. They paid us ahead of time. Again, we're Disney cruises or Carnival cruises or whatever. We've been paid ahead of time for a cruise we haven't delivered yet. So as a result, we have a liability set up, right? And so we've been paid ahead of time. So we have a liability. Now we're gonna. This is the adjustment. This is not the initial entry. This is the adjustment. Remember, the initial entry is going to be a credit to liability and an increase to a debit to cash. So you go debit and credit that equal each other. But this is the adjustment. So we deliver the product, and so as we're going to debit that out, we're going to now move that over to revenues because we've earned it, right? We've earned whatever it is we're doing. We did the cruise, right? So as a result, we've gotten that. And this is not a far-fetched example. There are a lot of entities that sell products and receive money ahead of time, and they still have to deliver the product in question. And there are lots of examples. Like anything that involves like tickets, for instance, is a pretty good example. Of course, insurance is a great example. And by the way, in the insurance industry, if you happen to work in the insurance industry, when the initial transaction is set up, this is not the adjustment. The original transaction, a huge liability is what we call unearned premium. And it's because of the nature of insurance is to charge or to collect payment ahead of time, because who wants to pay after the fact when you don't need the insurance? That's kind of the way it typically works. That's not every single insurance transaction, but that's typically what happens. And so this idea of deferred revenue is not a one-off. It's not that unusual at all for sellers of product in order to do that. Okay. Even things like deposits and whatnot are considered liabilities, and and once you've satisfied in the like you rent something from Home Depot, I think they probably collect. If you rent rent a truck from Home Depot, they probably collect a deposit. I would imagine. I haven't done that before, but I would imagine. And so they book an asset, cash, and a liability as a deposit, and they just simply reverse it once you've brought back the truck in good condition and whatnot. So lots of examples of deferred revenues that are collected up front. And by the way, it would become a revenue if you didn't bring the truck back in good condition. In fact, you may have another issue going on there, but that's essentially what's happening. So the adjusting entry for deferred revenue, in this case, this was rent in this case. And remember, they paid on July 16th. Now we got to kind of go back. And I know that we got a lot of different transactions we've been looking at, but one of the things that sort of, when I was looking at this and preparing for this, was the idea it was paid on July 16th. That's mid-month. So you've got something going on in the middle of the month. So they subleased space to a jewelry store for $500 a month. So we're assuming we're going to talk about half a month. Now, I wouldn't get hung up on the specific date here because there are conventions in accounting where if something happens between the 1st and the 15th, we call it the beginning of the month, 16th or the end of the month, even if it's 21 days or 28 days, it's the end of the month. So over time, these are not big deals, but you have to have a way to do it. And so in this case, it was on July 16th, and they received $1,000 in advance for the first 2 months' rent. Well, they only incurred half a month's rent, and so as a result, the company initially booked $1,000 as a deferred rent revenue and cash. So deferred rent revenue was the liability. It was the credit. The cash was the debit. So cash goes up. The liability deferred rent revenue goes up by $1,000. But now we're doing the adjusting entry, that half month, which is $250. So now we're going to move some of that into taking out of deferred revenue, right? That liability is being reduced, and we're going to recognize revenue. Now, this leads me to my next point, which is going to be a pretty significant topic in this course, and that's what we call revenue recognition. And when does a company recognize revenue? Expense recognition is also an important topic as well, and we're going to talk about both of those. And in accrual accounting, it's really important to know when has an enterprise recognized revenue. And by recognize, I mean earned, and therefore booked as revenue in a particular accounting period, and what constitutes the earning of that revenue. What are the characteristics of the event that mandate us to record it as revenue? And the same goes with expenses as well. And again, we're not following the money, we're following the activity. In cash basis accounting, we would follow the money and everything's nice and easy. Not quite as easy when it comes to accrual accounting, which is the system that we operate under the GAAP accounting methodology. All right. Okay, one other thing we've got going on here is this is an adjustment for unearned revenue, and this is a different example. And let's talk about this one here. I'm going to try to zoom out a little bit, and hopefully this is working. I am not familiar with this particular this particular piece of machinery here, so I'm going to kind of do this. And so let's take a look at what's going on. The contra costa times company reported $17,200 liability in its 2021 balance sheet for subscription revenue received. Okay, well, subscriptions, that's another example of a prepaid item. It's a deferred item, right? And a lot of times people pay ahead of time for a subscription, and it's just one of those things. It's just the nature of this particular transaction. So in this case, we have a liability of $17,200. So I'm going to set up T accounts here. Again, T accounts are simply ways by which we can visualize how these events work, and so that we can answer the transaction or answer the question. And so we unearned revenue, and we have subscription revenue here. So unearned revenue, again, is a liability. Subscription revenue is revenue. It's an income statement account. This is a balance sheet account. This is an income statement account. And as of 12/31/21, we had a balance there of $17,200. Okay. And what we're ultimately being asked to do here is determine what is the liability amount for deferred revenue that will appear on the balance sheet in 2022. All right. Well, let's talk about what's going on here. So that was at the end of 2021. Okay. Again, we're assuming that's the year end. And so during 2022, $68,000 was received. And so as a result, throughout all of 2022, and obviously in the real life, you would have individual dates as to when these things were received and whatnot. And if it's a subscription, you probably have hundreds, thousands, tens of thousands of individual entries that would sort of work their way into some sort of journal. But what we're trying to do here is we're trying to answer a question as to what's going on with overall balance sheet items. So we're going to do a subtotal here. The subtotal is this plus this is going to equal $85,200, and we're given the fact that as of 12/31/22, that the income reported 69,700 throughout all of 2022. So this is a little bit different. The earlier question was, what is the income statement amount? Here, we're given the income statement amount, and that's going to be 69,700 that has been earned throughout all of 2022. We don't, various dates and different customers and all that. So what we have to do then is simply make the adjustment here, and we're going to adjust this downward. And what gets us, if we take 85,200 minus 69,700, right? 69,700, where we're now earning that revenue, we're going to end up with 15,500. That's just simply this minus this gets us to this. And so the balance, which is what we're really asked for here, 12/31/2022, is the amount that is in the balance, the liability that remains. That is still unearned. We haven't delivered the subscriptions, whatever. I guess this is a newspaper or whatever it is. And so that's really what is going on there. So it's a little bit of a different approach, but this is why we use T accounts in order for us to sort of visualize what's happening. The prior example I did a second ago was asking for what is the effect on the income statement. Here we know what the effect of the income statement is because it's given. All we want to do is do the adjustment to unearned revenue. And that's what an adjusting entry really is bringing things current based on what we know now to be happening. Okay? All right, so this is kind of a look at what's going on with adjusting entries. They really are important factors when it comes to understanding what's happening with the enterprise overall. We have to make these adjusting entries, otherwise things are going to be wrong, and it's sort of a routine maintenance kind of thing. Okay, all right, a little bit more, and I think I'm going to probably go just a bit more. Pick this up on Tuesday and during the regular class session, and I'm hoping I can get through the rest of chapter 2 because what I really want to do on the Thursday of next week, which is week 3, is to start to push into chapter 3 and be able to cover that. And this is why I sort of expanded the due dates, because it gives us more time to cover things and more time for you as well to get with me individually. And I know I've got a couple emails from some students, and unfortunately today, I'm recording this on Friday, we were at an all-employee event most of the day, and I had a meeting after that, so I'm kind of I've been sort of out of hand a little bit today, but I will reply to everybody, and feel free to engage in a dialogue with me. Email is a good way to reach me if you aren't on campus. If you are on campus, feel free to stop by. I'm pretty much here most of the time, and so I'm here to help you as best I can. All right. So one other thing, and this is sort of the last bit here, which kind of goes back to what we talked about, the alternative approach, where we're dumping everything into the deferral account, but we have to make an adjustment for that. So, and that's very similar methodology as before, where perhaps the bookkeeper is not really that skilled or well versed on that, and they're just simply dumping things into particular accounts, but they do have to be adjusted if the entity that we're talking about is using an accrual accounting method, and not all companies use that. Now, I think probably it's safe to say that if you are working with small businesses, a lot of small businesses use a cash basis system, and certainly when I was very early on in my career as a commercial lender, we had a number of companies that just used cash basis because it was easier for them to work with, and frankly, the difference in results between cash and accrual is probably not that serious. So it's the cash basis. I don't mean to demean that at all, because a lot of companies find it easier to use, particularly for smaller businesses. But for publicly traded corporations, accrual accounting is absolutely the way that they have to be done. Okay. All right. So I think we're ending up here. So I'm just got a little bit more to talk about. I want to talk a little bit about accruals here and what accruals are all about. So let's talk about this concept of accruals. And oops, what did I just do? About accruals. So again, unlike deferrals or prepaids, the activity comes first and then the money comes later. It's just the opposite when it comes to deferrals, where the money comes first and the activity comes later. And we have two different versions of this. One is accrued liabilities, the other is accrued receivables. And many of these do involve what we call external transactions. That is, they're outside parties. And one of the ones that comes to mind here a lot is interest. A lot of companies have debt, so they have debtors. And so accrued interest is a liability, and they have to bring that current. This is not something that is event-driven. I mean, they may get invoices and whatnot, but if you're cutting off an accounting year or any kind of an accounting period, you're going to want to bring this current to reflect the fact that there is that liability interest. That's a big one. Or not just interest payable, which is a liability, but also interest receivable that you haven't received yet. And so this is also a very common bit of things. So interest, I know it's not the only one, but it's one that comes to mind as definitely involving external parties. And that's interest would not necessarily be the case with internal transactions, although there are inside transactions. There are companies that were particularly closely held companies where owners will borrow from the company or lend to the company, and there's interest going on and whatnot. But for the most part, publicly traded corporations, not so much the case. I think of interest as being something that's considered external. And then internal ones, again, things like accrued salaries and wages are critical for a lot of companies, particularly service entities, where there's no real inventory, there's no manufacturing costs. Employee expense are some of the biggest ones that there are. So the adjustment here is to do what? Well, if you've got in this case, an accrued liability, let's just take the example of accrued interest and whatnot. This is how we adjust it is this. We simply record the expense. And let's just say that we borrowed money on December 15th. We close out our year on December 31st. Well, we've got between the 15th and 31st some accrued interest. And so we're going to record that expense. And we're also and that's going to be the interest expense, okay, if it's interest. and the liability is going to be interest payable. And so the effect on the income statement is income is going to go down. Why? Because the expense has gone up, and the balance sheet is going to incur a liability, which is going to bring down shareholders' equity, all else remaining equal. And so that's what the adjusting entry looks like for that. And that's a very simple thing, just to kind of bring that current in order to do the adjustment. So adjusting entries are always kind of a thing that a lot of people are not terribly familiar with, and if they haven't worked in the accounting field before, and they may be a bit unfamiliar, but they are things that need to be done in order to bring things current. So back to our example on the Dress Right Corporation, they paid employees $5,000 for salaries for the first half of the month, but they've still got salaries for the second half of $5,500, but they haven't paid them yet. Now, again, I talk about accrued liabilities. This is a classic case, because I can't think of too many companies that don't have accrued wages and salaries. Unless you're a one-person operation, I don't know. I mean, most companies have employees, but employees don't get paid every day. I mean, they get paid on a schedule. And so as a result, we cross an accounting period, and they're not going to be paid until early August. And so as a result, we've accrued $5,500 of salaries expense, which is a payable. So we recognize the expense. We're incurring the expense in July because it's been incurred. We just haven't paid it yet. And so it's going to become a liability. When we pay it, these things will reverse themselves, right? Actually, what's going to happen is, well, salaries expense is never going to change, because the expense it's done and gone. You can't change that. But payables is going to go to the debit, and cash is going to be the credit. And that's what's going to reverse this whenever in August those salaries are paid. Okay. So it's a very classic case in the accrued liability, which is primarily an internal transaction. And we come back to interest. Now, I want to talk a little bit about this, and I don't have too much more to go here in this particular video. But when we talk about interest, one of the things that we should note is that everywhere, when we talk about interest expense, and really this is interest expense, it's principal times rate times time. So principal is simply the dollar amount under discussion. If it's a note payable, typically, or whatever. The interest rate, all interest rates are expressed in annual percentage terms, unless you're borrowing from a loan shark that has a weekly interest, which we're assuming that's not the case here. It's an annual interest rate. And time is expressed in annual terms as well. So if it's 1 month, it's 1/12. And so I like to convert these to decimals. I just think I like decimals better than fractions, frankly. And so you have 40,000 times 0.1, which is the interest rate, times 1/12, which is like 0.0833. And you're going to end up with accrued interest of $333. Hasn't been paid yet, just been incurred. And this is a way to bring this current. This is an adjusting entry on a particular liability. Okay. Hasn't been paid yet, but it's been incurred, so we have to record it. And that's part of the accrual accounting concept. Okay. But always principal times rate times time. And again, think of these in terms of annual terms. And if you're very familiar with these, you might think, okay, I get it. This is kind of obvious, but it's amazing how many, even in my own career, some people did not know that interest was an annual percentage. But everything in finance is based upon those sort of annual terms. Okay. All right, a quick check here. Gary's Grocery borrowed $12,000 at 8% interest on May 1st, 2021, with P&I due on April 30th of the next year. So it's basically a 1-year note, looks like. Company's fiscal year ends on December 31st. And what amount of interest expense would it appear in the income statement for the year? All right, well, so we're going to bring everything current. What is this, 8 months, I think, of interest, right? So you're going to take principal, 12,000, times rate, 0.08, times 8/12, or what is that, 0.67? And so obviously it's a repeating decimal, but and you're going to end up with a dollar figure. And I don't know off the top of my head what that number is, but it's going to be, and it's going to be worked out here, $640. And that's the interest expense. What does that 640 represent? It represents accrued interest. That's going to be posted as interest expense for that particular accounting period. And that's going to be the debit. The credit is going to be interest payable. It's not payable yet. I don't know how realistic it is to not pay any principal or interest the entire 9 or 8 months or whatever. Most banks, if it's a bank loan, most banks require at least interest paid quarterly. but let's not quibble over what the facts are. It's just sort of focus on what the accounting looks like there. But I suppose private transactions, you can structure these liabilities however you want to structure them. Okay. All right. So that's one concept check. And when we talk about accrued receivables, because I do want to sort of wrap up and close out the accrual section here. What is the adjusting entry here? So accrued receivable, and let's just talk about interest, right? So we've earned interest, and so the accrued interest is going to be interest receivable. That's it's going to be accruing to us. But what is the adjusting entry? We're going to book a receivable, and we're also going to book revenue, even though we haven't received the money yet. It's still out there. So one example, I think an easy example is something like buying a treasury bill, right? 6-month treasury bill, and interest is paid at maturity of that thing, but you're earning interest every day that thing is around. So if you're 3 months into it, you're going to book the accrued revenue, and that's going to be your credit, right? It's interest revenue, and whatever the revenue is. In this case, it's interest revenue, and then interest receivable is going to be the debit. That's going to be the asset. Okay. And what effect it has on the income statement is it's going to raise income. Again, money, money hasn't been received, but it's going to increase income. And it's also going to raise the value of assets, and by extension, the value of shareholders' equity, because the balance sheet's always got to balance. So as a result, that's the effect of an accrued receivable. And the question may come up where, hey, what if we never receive this? Maybe it's receivable that we never collect on. Now, treasury bills are not a particularly good example of this, but there are a lot of receivables that we recognize later that we're not going to collect them. And we have obviously ways of dealing with this. One is the allowance method, where based upon experience and judgment and whatnot, there's a determination made as to how much of these receivables are going to be collected and how much are not. It's an educated guess, and companies are wrong all the time. And hopefully, if you're wrong, you're overly pessimistic and you have good news at the end of the day. But nonetheless, there are ways to deal with that particular thing. And this is a recognition that there are those who would argue against the accrual method just based upon that money talks, right? And if you haven't collected it yet, then it's really not a revenue. Well, the point is well taken. I don't disagree with the logic, but in accrual accounting, we would book the revenue, and hopefully we'll assume we collect it, but we also have ways to make assumptions on the other direction for overall the inability to receive that. So in this case, the example that we've got with accrued receivables, interest being the classic case here, assume address rent loan another corporation $30,000 at the beginning of August. Terms of the note call for payment of principal $30,000 and interest of 8% in 3 months. Okay. And in this case, what do we have here? Well, all we're simply doing is we're simply saying 3 months of 1 month of interest. Actually, what are they asking us here? I guess they're wanting to adjust it as of the end of August, I guess. All right, well, that's fine. So it's principal times rate times time, 30,000 times 0.08 times 1/12 is going to be $200. And so interest receivable is going to be the asset, right? It's like an account receivable, it's an asset, and the interest revenue is going to be booked here. And I guess we're cutting the month off in August, or the accounting year off in August, which companies do. And year ends for companies are all over the place, so it's not always the case in which we're going to be looking at 12/31, December 31st. It's December 31st is very common, but it's also not exclusive to any organization at all. Okay. And then finally, this will be the last thing I'll talk about here in this particular presentation, is that of the idea of estimates. I alluded to this a bit earlier, particularly in talking about depreciation. And that's the idea that we are estimating a useful life. And it's really not known for sure. I mean, you buy an 18-wheeler and you think it's going to last 5 years, maybe it lasts 10 years, maybe it lasts less, or whatever the asset is that's depreciable. It's based on what we expect to have happen. Now, by the way, if we think it's going to last 5 years, it will last 4 years, and the thing is turned out to be is worn out and can't be repaired, it's been maybe crashed, whatever, then we have a way to write that down. We're not without resources there. And some assets are impaired for various reasons, so we can make that adjustment as well. depreciation is established ahead of time at the acquisition, and the estimated useful life is an estimate, and but it's got to be based upon a good faith estimate. And so, as well as the residual value, which I think is maybe even more challenging. What the heck is something going to be worth in 5 years, 10 years, 15 years? I mean, do we really know? And in tax accounting, we don't even include the issue of residual value typically when it comes to depreciable assets, mostly because it is really, really hard to know. And I mean, we're talking about computer equipment. If I have a 10-year-old computer, what's that going to be worth, at the end of 10 years? Probably not too much at all. Okay, so that's one example. And then the topic which I just got off talking about, which was bad debt, and that's the idea of receivables that will not be collected. And we typically use what's called an allowance method. We'll come back to that a bit later. And I think you even get into that a bit in 2130 and Intermediate 2. But there are ways by which we can say, okay, we estimate based on past experience or judgment, economic conditions, whatever, our own client conditions as to what we expect to receive, what we don't expect to receive. And bad debt, I think you just have to expect it's bad debt is a cost of doing business. There aren't too many entities that have no bad debt, except if all they deal is a cash business. And even there, you've got issues concerning things like shrinkage and whatnot. But that's unrelated to bad debt. All I'm simply saying is that there are some expenses that are unavoidable, and bad debt is one of those. Nobody likes bad debt, but what are you going to do about it? I mean, it's a fact of life. And in some industries, I'm thinking healthcare, it's absolutely rampant. And where did I see? I saw some study not long ago, a couple months ago, about the amount of hospital debt that doesn't ever get collected. It's just astronomical. It's just unbelievable in both percentage terms and dollar terms. And so this is just a reality of some industries. Some have better experience, some have worse experience. Okay. All right. And final thing here, because we're sort of wrapping this up. The trial balance we did, which was unadjusted, now we've made all these adjustments, now we do another trial balance. And so, again, we're trying to make sure that debits and credits equal. And so in this case, they do. And as a result, now we move to really the final step here is preparation of financial statements. And this is where we're going to sort of leave this, and we're going to come back on Tuesday to talk about what we do. Now, by the way, this is in order. The income statement comes first because we're closing out those temporary accounts, and we're sort of dumping these revenue and expense accounts in the income statement. Well, let me come back to comprehensive income a bit later. It's where it's not really operating items. They're kind of tangential, but I'll get to those. And then we'll go to the balance sheet from there, cash flow statement of shareholders' equity. And these are done in order. And this is really what financial accountants are up to, is to present to external users primarily what's going on with that particular company for this particular period of time that we're trying to encapsulate. All right. Okay. Well, again, I'm going to stop right there and post this video. It takes a little bit, and by the way, it takes a little bit of time for me to post these videos because there's sort of a compression that's going on. I'm not a tech person, so I think it's converting it to MP4. It takes a little bit of time, and during the regular class session, Tuesday, Thursday, there's a class that comes in right after hours. And so I don't really have time to be here because the instructor that follows me has got to come in. So I don't always get these up, right after the class session ends. So kind of bear with me on that. And I know yesterday, September 11th, was a little bit of a weird day, but I will try to make these available just as soon as I possibly can. But given the limitations of the fact that this room is used, this particular room here in Smith Brasher is used a lot during the day, and I just simply don't have access to it. I record it to the computer as opposed to the clouds because I think it's a better way to go. But it does take just a little bit of time. All right. Okay. If you have questions about anything, again, feel free to reach out to me. I'm available and more than glad to help you out. And I will see everybody next week. So have a great weekend, everyone.